Yet again, I'm back, your host, in today's video presentation. My name is Alwando Franklin. I'm the lead tutor, the Chief Executive Officer, and the pioneer of SEO Accountants Tuition Center. In today's video, I'm going to explain the two different profits and two different capitals that are used in determining the return on investment. Now, we have two types of capital and two types of profits that are used to calculate the return on investment, depending on the objective of the entity. So we have the return on equity, number one. Return on equity, we have the profit after interest and tax divided by shareholders' equity. Shareholders' equity multiplied by 100. So we have the profit after interest and tax and the equity. The equity is also referred to as the shareholders' funds. And the shareholders' funds, equity is a makeup of ordinary share capital, two, share premium, three, we have reserves. We have retained earnings. And then number four, we have reserves. So all these, when you aggregate, you get equity. So that measures the return on equity. Number two, we have ROCE, return on capital employed. The return on capital employed is measured as profit before interest and tax, which we also refer to as operating profit. Operating profit divided by the capital employed, abbreviation capital employed multiplied by 100%. Now, I want to explain that this type of capital, it is from the equity holders and from the debt holders. So return on capital employed focuses on both. What is the return for both equity shareholders and debt equity? What is their return? So when the examiner says evaluate the use of different profits and different capitals in the calculation of return on investment, it simply means what do you use when calculating the return on equity? And what do you use when calculating the return on capital employed? Now, I want to explain that when the objective is maximization of shareholders' wealth, both of these do not directly measure the maximization of shareholders' wealth. Reason being, both of them, they are based on profits are not cash flows. Maximization of shareholders' wealth is based on cash flows. Therefore, the methods that can be used should be: one, total return on shareholders' funds. Total return on shareholders' funds is a makeup of cash dividends, plus capital gains. Cash dividends, that is based on cash. Capital gains will arise when the shareholder, they sell their shares. And at that time, the market price per share normally will be higher than the amount they spent to acquire the shares. Therefore, there will be capital gains. So both of them will maximize the shareholders' wealth because they are in cash. Number two method that can be used to measure directly is NPV. NPV, that is net present value. These are based on cash flows. When the company has positive projects, positive NPV projects, the shareholders' wealth will increase. Number three, can also use EVA. EVA is economic value added during the year. EVA is also closest linked to cash flows because you have to make a lot of adjustments to eliminate the non-cash items. So when you have positive EVA for the company or for a project, it means value has been created for the shareholders. So basically, we can use these three to measure directly the maximization of shareholders' wealth. Now, coming to the question here, if we are calculating return on capital employed, we have profit after tax is 11.26. Then we have shareholders' equity, 1161, multiplied by 100%. This will give us 97%. Now, return on equity of 97% is very high. We may consider to use the market value. The market value of equity must be used. Market value of equity is equal to number of shares multiplied by market price per share. That will give a realistic return on equity. Number two, we can also measure return. Return on equity is equal to profit before interest and tax. In this case, we have the operating profit, which is 1811 divided by the total capital, shareholders' equity plus long-term, 8739. In total, this will be 9900 multiplied by 100%. This will give us 18. 18% appears to be reasonable, but now we have one cost. Restructuring costs do not recur. So we may consider to recalculate excluding the restructuring cost. When we exclude the restructuring cost, what will be the return? So which means you add 482 plus 1811 divide by 99 multiply by 100%. This will be 23%. So it is within the same range. Now, today's video is relevant to the students doing ACCA, Advanced Performance Measurement. Yet again, I want to encourage our viewers to ensure that they ask questions relating to this topic in the chat box. All the questions will be attended to depending on the availability of time. We also encourage our viewers to make comments in the comment section on the quality of this video. All the comments will be taken very, very seriously and will be used to improve the delivery of our lectures. Yet again, on behalf of FCO Accountants Tuition Center, I want to thank all our viewers for supporting us. God bless you beyond measure. Also, for the new subscribers, do not forget to hit the notification button so that you are notified whenever the videos are available. Thank you. God bless you.